Imagine walking into a grocery store with $100 to spend. You could only buy apples, or you could only buy bananas, or only bread. But what if someone had already put together a basket containing dozens of different foods? With one purchase, you instantly own a little bit of everything. That's essentially what an ETF does. ETF stands for Exchange Traded Fund. While that name sounds complicated, the idea is actually very simple. An ETF is simply a collection of investments bundled together into a single investment you can purchase on the stock market. If you invest into a single company, you're depending on that single business to succeed, but an ETF spreads your investment across many different companies. If one company struggles, the others can help balance things out. This is called diversification. Diversification helps reduce risk, although it can never eliminate it completely. There are different types of ETFs: total market like VTI, dividend-focused like SCHD, growth-focused like SCHG, international-focused like SCHY. Depending on what you're looking for in your investing journey, there is an ETF that will meet those needs. How do you, as the investor, make money owning shares of an ETF? Generally, in two ways. First is the share price going up. When the share price is higher than what you paid for it, then when you sell, you profit. Second is when an ETF pays dividends. You can either take the money as cash or you can set it up on a drip to reinvest and buy more shares. If there's one thing to remember from this video, it's this. An ETF lets you buy many investments with a single purchase. Instead of trying to predict which one company will become tomorrow's winner, you own many companies and allow time to work in your favor. Thank you for watching, and if you found this explanation helpful, consider subscribing for more beginner-friendly investing content.